In this video, we're going to start looking at an example to illustrate activity-based costing. And this is the same example pulled from the PowerPoint, but we're going to look at it in detail here. So the company we're looking at is Baxter Battery, and they give us their income statement for the year ended December 31st, 2021 here. So this is a traditional income statement. Sales minus cost of goods sold gives us gross margin. Then we list our selling and administrative expenses, and that gives us either a net operating income or loss. So in this case, they're operating at a loss. So in this example, Baxter Battery wants to try the ABC costing system and see how the numbers differ. So at the end of the day, there's still going to be the same bottom line, but the distribution of costs are different between traditional costing and ABC costing. So to try this costing system on for size, Baxter Battery just selected some activity cost pools and their related activity measures. So an activity with respect to ABC costing is something that causes a cost to occur. It ultimately is an event that leads to the consumption of resources. So with ABC costing, we take overhead and some non-manufacturing costs as well, and we dump them into these different cost pools. So these activity cost pools, each of them you can think of as a cost bucket. And each of these cost pools has their own activity measure or cost driver, so to speak. So the cost driver is that thing which is driving the cost or causing the consumption of a resource to happen. So what we're essentially trying to do is figure out how much of all of this overhead that we're looking at, how much of the overhead under this ABC system is being caused or being brought about because of custom orders or because of design changes or because of orders being different sizes or due to customer relations or other. So what we want to do here is take all the overhead under the system, divvy it up between these different cost buckets, and then use the allocation base for each cost bucket to find the activity rate for each activity cost pool. So here, these are the activity cost pools that they've chosen. So customer orders, this cost bucket will be assigned all the costs of resources that are consumed by taking and processing orders. Design changes, this cost bucket will receive all the costs of resources that are consumed by customer requested design changes. Order size, that cost bucket will receive all the costs of resources consumed as a consequence of the number of units produced. Customer relations, that cost bucket will receive all the costs associated with maintaining relations with customers. And other, it's going to receive all the organization sustaining costs and unused capacity costs. The costs dumped into this bucket are not assigned to products or to customers. It's these other ones that aren't organization sustaining or unused capacity costs. All of the costs dumped into these 5 cost buckets will end up being assigned to products, and if we're looking at a customer, to a customer as well. Okay, so this is probably the most complicated looking sheet, but it isn't really. There's just a lot of numbers on this page. So take a look here at this income statement. So this income statement has direct materials, direct labor, manufacturing overhead, and all those SAG expenses. So what this table over here does, it just gives a breakdown of all the overhead costs at Baxter Battery, including manufacturing and non-manufacturing costs. So the first one is just your manufacturing overhead. So this $14 million that we see here under the production department being broken down between indirect factory wages, factory equipment depreciation, factory utilities, and the factory building lease, that $14 million is the same $14 million we see here listed as manufacturing overhead that they've now just split into the different sources, what that $14 million is made up of. But then they take this $6 million of general administrative and the $2 million of marketing costs, and they break those down into their component parts as well. So the $6 million of general administrative costs are broken down into the admin wages and salaries, office equipment depreciation, administrative building lease, and then lastly, that $2 million of marketing cost is broken down between marketing wages and salaries and selling expense. So under the traditional method, it's only this $14 million, right, that is included as part of product cost to give us gross margin under the traditional method. But now, with ABC costing, we're taking not only the manufacturing overhead, but we're also taking non-manufacturing costs like marketing costs and general administrative costs, throwing that into one overall overhead bin and assigning those to products. And it's important to note here that this is just overhead, so we're not including direct materials, direct labor, and shipping costs here, because we see here's also $3 million of shipping costs. We're not including that in this table here because those costs don't get assigned to products, they're traced to products. Those are 3 categories of costs that we can immediately and directly trace to a specific product, because those are traceable costs. But all of these other costs here that we see listed can't be traced, or easily traced actually, so we have to assign them. So we're going to see now how to take all of these costs here, these overhead costs, the non-manufacturing and manufacturing overhead costs, and to how we're going to go from this table here to actually assigning those costs to products at the end of the day. But there's a couple of steps that we'll need to follow to get to that point. So I'm going to go ahead and pause the video here. We're going to continue on this next sheet on the next video. So just to keep this from being too long of a video at any given time, we're going to go on to the rest of the sheet here in the next video. So keep on watching.